The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd from FIIG Securities. Welcome to the Friday night edition. If you have any questions about the share or bond market, please pick up the phone and call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. Joining me on the panel tonight is Mark Barley from Equasia and David Novak from Wealthwise Education. Hello guys, how are you?
Hey. Good, thanks.
How was the week? Good week? David, how'd it go?
Oh, look, it's pretty volatile. Another volatile week, and especially in the banks. If CBA's just been up and down like a yo-yo. We had options expiring on Thursday, so there's a lot of match outs there. Also in the iron ore sector was very volatile with the iron ore price taking a bit of a dive of 5%.
Yep.
Saw Fortescue one day jump 4.5% and then down almost 7% and closing at 5%.
Yeah.
So I mean, you can't get much more volatile than that. So.
You start losing your hair, which I can't afford. How's your week been?
Yeah, I mean, I guess it was a volatile week. I mean, I guess our focus is more on the bond side of things, but even on the bond side of things, you had US Treasuries jumping all over the place, touching kind of 220s for the first time in a long time. Yep. Also, JGB's Japanese bond market as well, showing a bit of widening in yield there. A volatile week, and it's nice to kind of come through it onto a Friday and
get to the end and watch the sport.
Get a chance to have a chat about it.
Let's talk with you, David. I mean, in terms of Wealthwise, for the viewers that watch on a Friday, tell me a bit about your business. Where are your customers and what do you do in the markets?
Well, my customers are anybody who wants to invest in the markets, into stock markets specifically. I've been teaching for 16 years, been in the market. I'm a market veteran of nearly 30 years. I've gone through the School of Hard Knocks, and so what we teach are principles that I've learnt is fundamental analysis, how to pick growing healthy companies, but also combining it with the technicals, the charts in terms of timing. Yep. But also I'm a derivatives advisor as well for the last 20 years, so I also teach derivative strategies. And most importantly, when the banks were at those record levels recently, I advised a lot of clients to hedge the downside, which is by selling call options and buying put options, so the cost was very minimal, so they would have been protected on this downside.
So you minimise by the fact you've sold an option and then you use
the premium.
And probably a little bit more, because it would have been at those dizzy heights. CBA at 73 was probably, there was a lack of oxygen at that level, so there's probably quite expensive to be able to buy the put, but ultimately it's worked out to be a nice trade.
It actually wasn't, because the premiums that people were chasing, while the stock was going up, was quite excessive. So the implied volatility was very high, so therefore you got a much greater premium
on the call.
And nobody was looking at the put option as the insurance or protection, so that was, in fact, it cost you nothing in getting
cash flow.
Yeah.
How's the volatility affecting you? Is that a positive for you in the bond market in terms of your opportunities, or how do you play it out?
Yeah, I mean, I guess at Equasia, we wear two hats. We're a corporate advisory boutique, so we're advising issuers maybe when to tap the market, so whether we're the bond market or the bank market, and volatility creates opportunities for our clients on that side. But the small credit fund that we do manage, again, it presents opportunities, because sometimes you'll see bonds move wider where fundamentally nothing's changed. The technical pictures, for whatever reasons, got a bit weaker.
Just natural nervousness.
Exactly. Same as the equities move around. We have a long-term fundamental view on a company, and if something hasn't changed but the price has, then maybe that presents itself as an opportunity.
I mean, I think most of the customers at FIIG are driven by their desire to get away from the volatility. I understand that market professionals enjoy it, but what are your customers saying? Is it something where you want to have, and I have Roger Montgomery come on the show, and he said one of his goals is to have a low volatility experience in terms of the performance. How are your customers reacting to the volatility? Is it something they say, great, terrific opportunity, or is it more about, it's back on, we're seeing CBA move? And I'm trying to think about how the range of investors are all different. So in general, how are they reacting?
Well, again, it depends on the investor and their risk tolerance, number one. So, for like I was giving it on the banks, for example, with the extreme volatility there, using that volatility to hedge your downside was one example. But also at the same time, there's a lot of irrationality and selling that's going on, especially across the resource sector and energy in particular, energy space. So that presents some good buying opportunities, if you really start having a close look at some of those opportunities and the fundamentals of those companies.
Yep.
So there's opportunities there. You've got to know how to find them though. And also knowing timing when to get in, because you don't want to catch a falling knife. So
no, well, I did see some of the commentary coming out with they were saying buy BHP when it was at $30, $31, $32, whatever it was, and it was that you're about to catch a falling knife, but it's okay, try and catch it. We've got our first email for the night. Our email comes from Kirk, and Kirk says, hi, I'm not sure if this has been asked already, but if the Treasury market is a bubble and bursts, what are the best stocks to be invested in? I can understand to avoid banks and buy insurance companies, but which companies in the ASX 200 and or global equities would you buy? Regards, Kirk. Shall we start with you in terms of if there's a bubble in the Treasury market, and I presume he means both all government bonds, which are the stocks to be invested in? He's saying you should buy insurance companies. I'm not quite sure why he wants to do that, and avoid banks. But
well, I can understand the insurance company one, because insurance companies get a lot of investment income from interest floating rates. So as for QBE, for example, with the high interest rates, that'll certainly positively impact their earnings. Also with a weaker Aussie dollar as well.
And from 0.3 to 0.5. But still, in terms of actual numbers, it's crap. But I get your point. But what do you think if there's a movement in the Treasury market and the bond market?
Well, I guess if we are in a bubble and it does burst, it probably means that the global economy is recovering. So it means that the US economy is doing better than people thought, and therefore, the Fed and other central banks are happy to ease back on QE, maybe raise rates. So, you probably want to be in those sectors more on the more cyclical side of things. I'm not an equity expert by a long shot, but in terms of a bond portfolio, if you're worried about that, then obviously there's ways to protect that in terms of floating rate notes and shorter duration portfolio, and we've talked about that previously on the shows.
I think I hear what Kirk's saying, and I understand the idea. I think, and we'll talk about QE after the break, but the problem with QE is the size of it. It's just the idea of trying to unwind this in an orderly manner. That just isn't going to happen, and they must know that. So it's a question of how you're going to react to the market. At this point in time, institutions are trying to take advantage of the Fed because they think it might be a sign of weakness. I'm not so sure. I don't think you want to fight the Fed too much.
I've got a slightly an opposing view actually of what Mark just said about the economy would be in a good state. What I see, I was teaching in the States for about 5-6 years up to pre the GFC, and I was warning. I could see the GFC coming with the debt bubble growing, especially in the housing market. So I was warning that this is not sustainable. At least 2 years before. And to me, the same thing is applying in the bond market, because what I see is, if you actually look at the growing deficit, the US fiscal deficit and debt, it's more than doubled. They're running a $1 trillion fiscal deficit, which is not sustainable. They haven't really done anything to really make an inroad there.
We can talk about sequester in a minute and how the Republicans have got control of the agenda a little bit, but we have a caller.
Okay.
Our first caller is Eric from Sydney, and he wants to talk about volatility. Hello, Eric. How can we help you?
Thank you, Mark. Look, I understand with bonds, about getting a guaranteed basic income over the period of time you're in the bond. I'd like to ask David, you're harping on about CBA. I've been a CBA shareholder for many years, and I understand the volatility in the share price, but there's also, the volatility which is in the dividend is really not there. I just challenge the panel and ask David to do a graph of the dividend over, say, about the last 13 years, and you'll see it's a really even increase over time. The volatility is another thing, but just a thought, fellas. Thank you.
Great question, Eric. I suppose. And I'll add to Eric's question. I think one of the things that are very hard to talk to all of you is and get to all investors is that they're all so different. Their attitudes towards risk and volatility and their outcomes in terms of all their investments. Am I a 50-year-old, 70-year-old? Am I 30? But to Eric's question, his view, I'm there for the dividend. I like the consistency in the dividend. I don't really mind the volatility in the price.
Yeah.
It's gone up from 58 since the, let's say, November, December, up to 73, down to 67. He's saying,
Well, yeah. I didn't say that it's not okay to hold CBA, especially depending on when you bought it. I'm talking about the volatility at the, when people were chasing it for yield, and I said 2 weeks ago on Your Money, Your Call, equities, that this is yield trap, and there's going to be a sharp correction here. I could see it. I've been around the markets for a long time. You can see when things spike up and everybody's getting overly excited that they're not seeing the downside. I'm misinterpreted. I think Eric's misinterpreting what I'm saying. I'm saying that if you're a long-term shareholder and you bought the banks in the early 90s, which I thought was a great opportunity back then when CBA was like $5 or $7, then you hold it for yield. You don't care. You're getting very positive cash flow, so you don't care about the volatility. Now, obviously, the biggest impact on the banks that could happen down the track is if we see a deteriorating economy, a slowing housing market, increase in unemployment. Well, that's going to hit earnings of banks, and then you'll see a re-rating of the bank stocks. That hasn't happened.
And it'll happen to most corporates.
Yeah.
Well, we have to go to a short break. Please give us a call on 1300 30 34 35, and the email is yourmoney@skynews.com.au, and we'll be right back. Welcome back to Your Money, Your Call. I'm Mark Todd, and tonight I'm joined by Mark Barley from Equasia and David Novak from Wealthwise Education. They're here to answer any of your questions, so please give us a call on 1300 30 34 35, and the email is yourmoney@skynews.com.au. All the feds of all the planets are all aligned. They're printing as much cash as they humanly can. Let's try and go through them and get your interpretation. Bernanke blinked. I mean, what do you think in terms of the US Fed and their performance? And I'll make the point, he's in a hostile environment when he answers any question from a Republican, and the Republican says, when will you look to unwind? And it's as if he's forgotten there's the rest of the world looking, because he blinks and he says, well, we'll start looking at it.
Yeah, but it was also in the minutes as well. In terms of the thing that spooked the markets was the phrase. A number of participants are talking about June as a potential starting point for tapering QE. Now, I think the market took that as incredibly hawkish, probably more so than it should have done. And I think Bernanke is still there, saying, look, at the end of the day, if the US economy and the data isn't there to allow us to wind back QE, we'll keep it as is, or potentially, if the data is so soft, we'll increase it. And the market, for whatever reason, interpreted the statement and Bernanke's comments more hawkishly than they should have, because the Fed is always going to be there. Bernanke is a great professor of the Great Depression, and he does not want any excuse to be labelled with that in the current time frame.
Well, I think they don't have a choice, really. They've got to keep their QE going. The problem is it comes back to the spending cuts, and reducing the deficit and debt. I mean, that's unsustainable, and this is what Bernanke has said himself at every testimonial he's given, every quarter before the Federal Open Markets Committee or the Senate Banking Committee he's said that fiscal monetary policy can only do so much. What's really required here is fiscal restraint and cutting, and he said, or
maybe raising taxes. You need to get your house in order. He says it all the time,
and he says it's not sustainable himself. So,
which was consistent with when they were doing the sequester. And for the viewers at home, the idea is that we'll do lots of furloughs, we'll do lots of cuts, and we'll bring in some spending cuts. The Democrats made it so draconian they didn't think the Republicans would pass it, and of course the Republicans passed it, and that was the irony of it all. Yeah. Obama wrote something he thought that would be impossible, and they said, yep, deal done. People are taking furloughs, forced furloughs. Bernanke said, don't do this. But the data coming through at the moment is that the US economy is continuing along its path, and we're not seeing any dramatic effect. We've got the Chicago PMI coming out tonight, but everyone is looking for what Bernanke said. Bernanke they believe to be right, but he might have actually got it a little bit wrong.
But the problem is it's structural. It's a structural issue. And what I mean by that, because of globalization, and we've got China, India, Brazil, or the BRIC nations. I mean, the West can't compete on wages, and this is the problem. Is that we've been the hungry ones to buy their Chinese goods, and at the so we're the spenders and they've been the savers.
Yeah, but I'd argue here that the US manufacturing sector has driven the economy. You know, Obama created some tax changes. He had some jawboning and some moral suasion, and said to people, "You need to bring these jobs back, otherwise we'll start to name and shame." And that both the gas and the manufacturing sector, cheaper energy prices, lower currency.
Yeah.
You know, when I was living in the States, they all talk about how great their economy is, how it can adapt, and I always think, yeah, whatever. You always say that, but they were right. They adapted very well.
Well, until now.
Yeah,
you know.
I think they're really struggling now, and I think part of that goes back to the housing market and the housing collapse. You still have a lot of people with negative equity, and one of the great things about the US economy in previous recessions has been labour mobility.
Yeah, absolutely.
And people being able to move from state to state to find where the employment is. But if you've got a negative equity house, sure, you can throw your keys back at them through the post, but that's not always the case in every state. And then equally, then you've got to build your credit score back up and rent somewhere else. So I think
and you've got the tax problem.
You do.
That's the irony of the US system. We always hear about how you can claim your interest, but of course, if you throw the keys back, now you can't claim this interest. You have a negative tax number with the IRS, and they come for you. So it's an interesting thing where you assume I'm debt free, but you're not. You owe the government. But it's a good point about Bernanke. He saw that the property market was where the problem started. He saw that's the solution. Drove the long bond. He said the long bond's got to get lower, so that the mortgage rates at 3% for the homeowner makes it sustainable. He's right. He's got that right. So that comes back to where do treasuries go?
But equally, you're seeing mortgage rates start to rise now.
You won't like
for the
that.
First time. Exactly. So it's kind of like how do you manage that and keep that low? And that's the problem that they've got. You know, there's such a large proportion now of the treasury market and also the mortgage market, the agency bond market, and keeping those yields low. If they continue with QE, you can do that for a while, but then you become 50-60% of the market, and then how do you extract yourself? Well, we've already seen the wobbles that are happening in the market on the pretense that maybe it's sometime in the future.
And it's because of the anomaly of the mortgage market of the United States that it's feeding on itself. Yeah. In other words, as interest rates go up, what the banks have to do is they have to sell treasuries to maintain their spread, their margin. It can be very complex to explain this through, but the essence is they then start to sell themselves.
Here's one that's always bemused me, and I've never quite got the answer for. Maybe you can answer me this question. You know, they guarantee, like, it's a 30-year fixed rate they offer.
Yeah.
So how do you guarantee that? You know, if they all of a sudden have a major sell-off in the bonds. That's what they start. That's what I mean. Yeah. So the bank guarantees it, and what he then does is to hedge himself against the guarantee he's provided you. He starts to sell the bond. So if he's giving you a 30-year mortgage, he has to affect his duration because now you're not paying it off any quicker. He starts selling. It's
and also that investors will buy that 30-year product.
Right.
But also on the flip side, they can refinance at any time. So as rates have been coming down, more and more people have been refinancing, which is what part of the problem was in the GFC, that people refinance right at the top because they were allowed to do. Whereas in the UK or in Australia, not as many people refinance and take equity out. So they were taking equity out right at the top of the market. So a lot of them had negative equity valued, in the highs of 06, 07.
Well, it's interesting about the refinancing because just quickly in the UK. One of my friends, he's got a couple of investment properties there, and he said he won't refinance because he's got the low rate. Because if he does refinance, that's why they're not selling the properties over there.
That's right. That's
because they're going to be paying higher interest rates.
Different loans.
So he's doing everything he can to keep those
yeah, that's the key with the different loans, different jurisdictions. Yeah. Look, we have to go to another short break, but please give us a call on 1300 30 34 35 for any questions on investing. Our email is yourmoney@skynews.com.au, and we'll be right back. Welcome back to the program. Our phone lines are open, so pick up the phone and call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. We're going to start with another email. The email is from James, and he says, "Hi, I love the show. It's very informative and one of the best going around at the moment. I've heard you talking about capital structures. I'm worried about the equity market and the volatility. Where in the capital structure should I put my money?" James, he's a discerning critic. He likes the show. I love that. Capital structure. I mean, I get the sense of his question. I mean, it's something that we've been really banging on about, the fact that the higher in the company, the more senior you are in the organisation, equity being the riskier, senior being the safer. Where should James go? Does he go right to the very top? Or does he look at some of the subordinated, or does he look at some of the hybrids? And I understand you can't be too specific, but in general,
I mean, it depends on his comfort and what his risk appetite is.
Clearly,
and
that disclaimer is mandatory.
Yeah, absolutely, and also his time frame for investing. But as you say, if he wants higher volatility but potentially higher returns, and you stay at the bottom of the capital structure in the equities, and then potentially the hybrids, which are again equity-like but higher returns but a bit more volatility. And if he wants to be in the the creme de la creme of a bank capital structure, then maybe you buy covered bonds where your rate of return is only 80 basis points over mid swaps, but you're getting a AAA type security with lower volatility, lower return. So you can choose where you want to be in that capital structure.
And of course, David, the thing is that if he goes much senior, he should expect a lower return. But if he goes for a floater that are 80 basis points over BBSW and it's in covered, it's very safe, he might be looking at some interest rate cycles that he's comfortable with as well. So if he thinks that I think rates are going up to stop inflation or to put the brakes on the economy, he might want to move up the capital structure. I do think at the moment there's some really good value in the subordinated, so not quite the senior, but coming down into the more middle part, and people can get some reasonable returns, particularly on the four majors, to the point that Eric made. They pay their dividend, they pay their debts. I think they're quite comfortable from both sides. So I like the idea of buying a little bit of both, a subordinated piece on the majors, and at the same time buying some equity.
Yeah, and one point to mention there is Basel III coming in as well, which is forcing banks to improve their Tier 1 capital, their equity buffers, which benefits the bonds that are higher up in the ranking. So
for the viewers at home, when Mark's talking about the Tier 1, generally you'll see the change reflected in the hybrid. So all the documentation around hybrids now, where you're told you'll get equity if they look for a conversion. If they have some stress, they'll give you some equity. So that's where we're talking about the Basel III and about how we're interpreting all the change in the legislations. Let's go back to Feds. We didn't get up to our Asian partners here in Japan. What's your thoughts on the performance of the Japanese?
Oh, well, it's a bit of a kamikaze in my view. I mean, you just look at the yen look, it's such an aggressive stimulus. I don't know if they had to really come out that aggressively, because you think about Japan, it's a third of the size of the US GDP, but yet the stimulus is twice what the Fed is doing, and hence the stock market's rallied 60% since the November lows. I mean, it's incredibly aggressive, and that's why it's not surprising to see the sharp sell-off that we've seen in the past week in Japan.
But I mean, I suppose, Mark, the thing that was interesting to me is that when the Japanese started and came out with their statement, the Bernanke said, this is really good. I'm very comfortable with the way we're going to move the yen. It's all fine. And we've had G7 say, look, let's not sell the currency with the Japanese rate they're selling for all they're worth. I see all that, but it's the timing. The Japanese have actually only just started. They've got some really good data at the moment where there's some inflation coming through, so their assets are going up. But if we're looking at Bernanke unwinding in the June, July, the August, or September, and the Japanese just starting, they need to be a little bit more coordinated, don't you think?
Yeah, but think about this. Think about Japan. They've got an ageing population. I just heard the other day that they're actually selling more adult nappies than they are.
That's my standard.
But look, the other thing is that you think about the elder generation who are savers, okay? I mean, who are being punished. I mean, they don't want to go into the equity market. They're happy to sit on cash or bonds. But they're being punished right now because they've got no choice. Because at the same time, with the yen dropping about 30%, their input costs are going up. So their energy bills are going to go up. Their food costs are going to go up. So that's really punishing the savers over there. So, this is the problem with it.
I think they've been punished since about 1995. They've been it's just a definition. It's just a recalibration of the punishment. So I hear what you're saying, that they may not want to get into the equities, and they are quite strong in the bonds. But in essence, that's a big impact, that movement in the equity market
for people in the equity market. But I would guess a majority are not, if they're elderly population. They don't want to go into equities.
But I think as well, part of the reason why Japan had to be so forceful was because it stagnated for so long. It wasn't a 2-year crisis. It's been probably nearly 2 decades of stagnation.
23.
And they haven't decided. So it has to be something pretty huge to kind of shake people and say, look, it's changing, and you need to believe us.
I believe it was to get them out of their inertia or their depression. It's around. I mean, you look at some of the data points. There was a time there with the Imperial Palace it was valued more than California. I mean, there are data points that say, hang on, we've just got to stop here because that doesn't make sense. So they've come from a great height, very great height in asset price, but they do need to get that stimulus moving forward.
But you know, can I just again? I think in this whole low interest rate environment around the world, who are the losers? Are the savers? They're losing if they're not in the equity markets, and that's forcing people to go in. And that's the problem I have. Is when you have this sustained, manipulated interest rate environment to keep it low, as low as this, and the lowest in history, it creates these imbalances.
Yeah, but you can still get some great bond yields, and that's where they should be going. They go to those sort of yields. That's what they do.
I agree with David's point that you're keeping things artificially low. You are forcing investors to take additional risk and potentially not getting paid for that, whether that's in treasury markets or in equity markets. They're chasing the yield because they need the income, and the risk return is just doesn't balance.
I don't disagree at all in both the equities, both the bonds. I get all that. You're always looking for it, but I think the various feds would look around and say, well, it's your fault. And by that I mean the consumers aren't consuming. They're lowering these rates. They're saying, we're giving you the stimulus, go and borrow money, go and act, go and behave, do things. And no one is doing anything because the consumers have learned from I mean, I get why. They've learned from the GFC. And everyone is standing back on the side saying, I'm going to put my money in cash. I'm going to put my money in 2% treasuries because I'm just not moving. I'm not going to borrow money, and I'm not going to take those risks because I learned from the GFC. And they're all repairing their deleveraging. They're doing all their balance sheets. And I sort of get why there's no bad cop in this. They're all trying to move them down the dial. It's not really happening.
Yeah, but again, you've got to take into account the whole macro situation, unemployment being the number one important.
Sure.
I mean, would you be lending the Spanish government money right now at 4.2% with 27% unemployment and 50% unemployment with youth under 25? I mean, where's the risk reward in that? I mean,
they're at about 4.25%. So the Australian government's at 3.25%.
Yeah.
Okay. That means what we're about to decide and tell the viewers is go and buy Australian government bonds.
Absolutely.
Well, that's right.
That's your choice.
That's
right.
what you're saying. And viewers, don't do that. We'll get you something better. RBA cash rates. What's your thoughts on Tuesday? Could you, Mark, imagine they're going to cut again, or
no? I did get it right last time for a
clearly
change.
You were the one. I said no. You said yes. We're in trouble. But
but I don't think they go this time. I think they just hang fire. And I think what's the best that in terms of those expecting an easing bias is to get some wording around an easing bias that was in previously that they took out on the last time. And if that happens, then I think maybe July and August they're lining themselves up again. But I think with the capex data and the data that we've had. Yeah, we've had a few wobbles in the equity market and asset classes offshore in the meantime, but I think we'll just stay steady for June and we'll look to July and August.
I agree. And also with the Aussie dollar coming down, that's taken off a lot of pressure off the RBA.
Yeah. Okay, we're about to go to Speaker's Corner, and before we go to Speaker's Corner, we're going to have to crank it up and have a break with the Speaker's Corner. And David, you're going to lead us through. Okay. So David, you've got 30 seconds to tell us what you think is most relevant to the viewer at home. Starting now.
All right, well, what I think is relevant is, given that we're seeing bond yields going up, especially in US Treasuries, I actually like insurance stocks like QBE, for example. The Aussie dollar's come down. Most of their income, 42% of investment income, is from fixed interest. Not fixed interest, but floating rate interest. So therefore, I see QBE's earnings going up high as long as there's no more natural disasters. But I see a good trend in QBE share price going forward.
We're on QBE and we'll talk about them on the way back. Welcome back to the Bond edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me on the panel tonight is Mark Bailey from Equasia and David Novak from Wealthwise Education. If you have any questions at all on the bond market or the share market tonight, give us a call on 1300 30 34 35 and the email yourmoney@skynews.com.au. Let's talk a little bit about hybrids. Can we just talk about Macquarie? What were your thoughts? We had an email that came through last week and we didn't get a chance to get to it. A client, a viewer asking about Macquarie. When it came out, what was your Equasia? What did you look to do?
Yeah, I mean, for our fund, we thought it had probably too many equity-like characteristics. It was a mandatory convertible. It's a perpetual. It was the coupon was discretionary, non-cumulative. So in terms of the the equity debt continuum, it was certainly down towards the equity side of the spectrum, and I think it priced at around about 400 over.
Yeah.
So for us, we thought that was a bit tight, and we actually preferred other opportunities within the debt space that were more debt-like and provided a more probably predictable kind of cash flow.
Did you get a chance to look at the Macquarie hybrid?
No, I really didn't. It's not my expertise. I mean, certainly I can talk about Macquarie Bank itself, but not the hybrid. I haven't.
What do you think about Macquarie Bank?
I think it's overpriced.
What price is it?
Well, it's come down from about a high of about 47 to 43, but it had that massive jump from about 39 up to 47 in a week. And if you look at the yield, it's like 4%, even partly franked, I think, which is in the lower end of the yields that you're getting in the banks. So yes, it was a good result, but did it warrant a jump of like 25% or something ridiculous in the share price? So to me, it's it's $43 now. I wouldn't be a buyer of it. I'd stay away.
Right. I think we're going to talk later on in the show about bond bubbles and asset bubbles. Whether it's an equity bubble, bond bubble. But in terms of the hybrids, I feel that the hybrids have lost a little bit of their steam. There are a lot of people came to the market with hybrids, and all the four majors did it, and they did it well. Yeah. But then other people started to come to the market, and the regulators started to get a little bit choosy, and some discussions around how that went. And what's your interpretation of the hybrid market going forward as a fixed income asset class for people?
Yeah, I mean, I think it's a great one for the retail investor, that in the sense that you have got access to it on the ASX, and you can buy it in small parcels for your portfolio. I think a bit of the problem that's actually happened is that the rating agencies have changed the methodology in terms of the equity credit that they give towards some of the hybrids. So some of the companies that potentially were going to issue hybrids and that would have been given 100% equity guarantee, equity credit, are now only going to get 50%. So it's not as worthwhile for them to do that. So I think
they're less likely to issue.
Potentially less likely to issue. I think that's what the change has been. So that's what stopped it on the corporate side. I think you're going to still see your domestic majors still hit that market for hybrids continually, and that's part of the reason we've stayed away from the domestic majors, because I think that you're just going to completely satiate demand, and it's not going to be a limited supply.
It's not going to be an institutional piece. Dave, we've had the institutions that have come on the show, that they've spoken about the fact that it's clear to them that it's a retail offering and it's not an institutional offering, and over the counter they can just get better bang for their bucks. So they've sort of left them alone. Let's talk about bond bubbles. You're a little bit negative on the bond market in terms of the US Treasuries.
Yeah, absolutely.
Let's have your thoughts on
not just me, but Warren Buffett as well.
Yeah, but now come on. Let's cut to the chase. When Warren spoke about it, he was talking about US Treasuries, and he was talking about US junk bonds at under 5%.
Yeah, that's what I'm talking about.
But when people say bond bubbles, they aren't really talking about the corporate bond market. They're talking about the government bond market.
That's right.
And what happens is the viewers at home think it's all bonds, and that becomes a challenge when you're trying to articulate the fact that there's so many different types of bonds around.
And I think you got to be careful describing the bond market as being in a bubble, because unless the US government goes bankrupt, and I don't think anybody thinks that's going to happen in the next 10, 15 years, because they've got their own printing press, that bond may fall in price in the meantime, but if you hold on that bond to maturity, the yield that you buy it at today will be that yield that you pick up throughout until maturity, and also you get par back. So it's not like equity where potentially it could fall to zero or close to zero if the company does go bankrupt. And that's so I think it's almost like the equity market is kind of trying to terminologize, if that's a word, the bond market in terms of this bubble type.
What was that word?
I'm not going to say that.
Thank you.
But if you look, look at the Chinese. Okay, here are the biggest holders of U.S. Treasuries. The Chinese. I mean, they've got close to $2 trillion, I've heard. And you think about that as an investment and what's happened to the US dollar. I mean, really, they've had a negative return, and that's why the Chinese are net buyers of gold. I mean, they're taking a hedge.
Yeah, but I mean, that's much more complex. It's not as simple as that. I mean, the Chinese are buying the US debt, so they're giving the US the money. The US are buying the assets of the Chinese putting out. I mean, it's a lot more.
It's a good factoring system.
Yeah, it's a lot more complex than I'm just holding the debt. And I understand there's political suasion around let's have a different currency as the global currency. But in reality, the US issue in their currency. They're the only country that can do it. Everyone buys their currency, that buys their debt. It's a self-fulfilling prophecy, and their productivity, their capacity to work their way out of that is probably more than any other countries in the world quite a positive opportunity for them.
Okay, but let's get back to the core issue here, which is if you're printing paper, I mean, you're adding supply. What's that going to do ultimately to the value of that currency, which is what everybody wants. They want everybody wants a weak currency. That's why Japan's taking this aggressive move. I mean, imagine if the RBA turns around tomorrow and says, well, let's start the printing presses and start printing Aussie dollars, and the Aussie dollar collapses back to 50 cents again. Great for our exports, but not good if you want to travel or purchase overseas, and our costs would go up. Inflation would be much higher for us.
Yeah, I think clearly at FIIG we think the greatest threat is the inflation piece. So we're always telling customers, you buy inflation-linked either inflation-linked annuities or inflation-linked bonds. So it's either the Sydney Airport, or it's the Proco, or it's the Investor. It's there's a whole array. I talk about Sydney Airport because that's the greatest spread at the moment. It's the most attractive. You can get in the low 4s plus inflation. They're just a fantastic bond because it's a small issue, and I definitely agree. It's not a function of when, the timing. That's the issue. It's not when it'll happen. It'll definitely happen. I just don't know when. What do you do for the inflation risk for your portfolios?
Well, we try and manage that through having floating rate bonds in there. So obviously, if inflation goes higher, your RBA base rate and BBSW will trend higher as well. And also, if you buy higher yielding coupons as well, you get protection there in terms of the duration's a bit shorter, and also you're picking up additional carry to protect you against higher inflation as well. But I think going back to the bubble in the high yield market, absolutely there's probably a bubble there, and it's a bit of an oxymoron in the fact that they're 5%.
Yeah, it's the US market. Yeah. That's the bubble that people are talking about. We'll show some charts later on about how the Australian, we've just decided that we buy Australia because Spain's at 4, we're at 3, so we buy here. But we will talk about that after the break. We have to go to another short break. Please give us a call on 1300 30 34 35 for any questions on the bonds or equities, and you can email us at yourmoney@skynews.com.au. Welcome back to the Bond edition of Your Money, Your Call. The phone lines are open. Please call us on 1300 30 34 35, and the email is yourmoney@skynews.com.au. We've been talking about treasuries. We've been talking about different asset classes. So you've brought some charts for us to have a look at. So yeah. David, we'll pass to you, and you're going to show us a chart on US treasuries, which you're quite negative on.
This is the trend. I mean, I follow trends, okay, and you can see the trend here from 1984, that is, to your left, all the way up to where we are now. This is most recently as of last night. Right. And you can clearly see that when the bond market is trending up, the US treasuries are trending up.
And that's a price chart, not a yield
That's
chart.
right.
Yeah.
That's a price chart.
So people who pay 100, 101, 100, 203 for the viewers at home, that's moving up, right?
So this would have been the best investment to make.
Ever.
This is 29 years ago. Absolutely. It's been one of the best performing asset classes in terms of capital growth. And also the yields that you would have been getting back in the 80s with high inflation as well. Fantastic. The 30-year bond was the investment of the the multi-decade. What I'm saying is right now we can see it, how far it's gone. That shows you the trend of interest rates have been going down for this long, which is the biggest secular bull market in history.
Yep.
And what I'm seeing is the pattern right now is that's starting to head down. So it's starting to show me a bearish pattern. So that's why I'm warning that no wonder the yields are going up, because we're starting to see a bearish trend here in the US Treasury bond market.
And when we talk about that, we then have to try and articulate for the viewers how that plays out for the people in Parramatta. I mean, how does that work out for everyone else? And that's the key problem, because the US Treasury market, the Fed is very much aware of where it's got the US market. It understands what it's done, and the RBA is conscious of it. When you see the minutes, they say, we need you to improve your fiscal performance. They talk about that. They talk about global fiscal performance. How is that ultimately, a year from now, how will that chart be affecting the people in Canelavar?
Well, I mean, I can answer. Well, basically, it's if you look at banks, we borrow money from overseas.
Yeah.
So their funding is also about 40%, I believe, from overseas. So therefore, if you're borrowing and rates are going up overseas, then guess what? It's going to impact banks' margins here, and they have to lift their rates here.
But if I had Kurt Zuber from Westpac sitting here, he said, "Look, I'll just lift the TD rates. I'll just lift up term deposits." At the moment, he's paying 3 bits of a penny. So he'll just, domestically. My point is, all this money sits on the sideline, or it goes into the equity market. There's tension around treasuries being sold off. The world economies are not necessarily strong enough to absorb a sell-off, and so all the people start to short the market. Well, if you can't borrow in the United States, you come back and borrow locally. There's all these pension funds. We're $1.6 trillion. It's a massive opportunity around funding.
Yeah, but I think wherever you're looking, if the rates on the treasuries are going up, probably your rates on the term deposits are going up as well, and there's competition for that. So your overall funding rates
are going to go up.
Yeah, and I get it, but I just don't see the same impact. I'm just so I do believe you don't fight the Fed, and that's where I'm at.
I think you're probably going to see low yields for an extended period of time.
I think for years.
Well into 2015 is my view.
Okay, well I differ on that one.
So where do you think yields? Where US 30 years will be? Where do you see it in a year's time?
Oh, look, I don't have an exact crystal ball.
No, but the sense of it, are we 50% higher at 3%?
I'm sorry, I'm highly pessimistic on the bond market. I reckon rates will go to 5-6%
in the US.
In the US.
So we go to 7. We'll be 2 over. 7.5.
Yeah, well, it'd be probably even higher. I'd suggest.
We always used to, when I was a kid, which was not that long ago, we were 2% over cash rates. That's historically what we've always been. We've been 2% above the States, and I guess if I was to be honest, I would suggest that the greatest problem I have right now is getting people to understand that the interest rates will be low for a long time, and you should accept a 5% return on a fixed income asset. That's the problem. If I'm going to bring Westpac at 7.5. I mean, that was the thing with the GFC. When they started issuing 8% term deposits, they just bit their arms off. I mean, I understand exactly what you're saying, but I just see that in terms of the way we're shifting our fixed income allocations, people tend to try and buy a bit more of that.
It's also relative to risk. If we're talking about sovereign risk, I was giving the Spanish bonds as an example. They were 7% only a few years ago?
Yeah, a few months ago.
A few months ago. That's soon, is it? Okay.
Yeah, but no one's buying those. So that's the point that people have. They're buying Westpac at 7.5. I mean, Westpac issued 2020s.
Well, they must be buying
at 7.5. It was, people buy that. The greatest problem right now in the term deposit market is that the people were getting 8% from Suncorp, Westpac, CBA, and that's rolling off 5-year term deposits at 8 and 10%. And they're saying, I like that. I like that return. I'm trying to work out where to get that, and they go and buy dividend performance because they want something similar, and they're seeing the volatility now. But if you can go and give them term deposits at 7 or 8%, I just don't think it's going to happen in the next year.
Well, we'll wait and see.
You brought some other charts. Do you want to bring up the other charts in terms of the S&P?
Well, yeah, the next
So
chart,
what's your thoughts there?
Well, this is the S&P 5. I just wanted to show you, this was the trend from the early 90s, and you can see, or actually 87 even, that little blip drop was the 87 crash, would you believe? To the far left, you'll see that sharp drop. That was the 50% crash. Quite irrelevant now when you look in the scheme of things. And then we had the
That's
huge
inflation.
Yeah, and then we had the huge equity rally in the 90s, the naughty 90s they called it.
Yeah.
And that was mainly on the back of falling interest rates as well. And then of course you had the dot-com bubble, so that was that first peak, then the collapse in the dot. And that fall down to 2001 was, this is where the Fed, in my view, made the biggest mistake. They cut rates aggressively from 6.5 to 1%. That created a bubble in the property market and the equity market. Absolutely. And then you had the GFC.
And where is that telling you now? S&P?
Well, we exceeded the all-time highs. We're above the.
So that gets sold off?
Well, have a look at it. To me, that's pretty straight up, and it's because like I said,
straight down.
Well, it could easily turn straight down if there's a bond. If the bonds come under more pressure, which they look like they are, watch out below for this equity market.
That just falls. So, and you brought one on the
our
ASX
market, the ASX 200.
Yep.
You can see there the big fall in the GFC there, but you can see how far we are from the highs of the the pre-GFC highs there. When you look at other equity markets in Europe, they've already exceeded, in the FTSE, the London market, the German market, the DAX, and like I just showed you here in the US equity market. And here we are languishing down here. We just broke above that level before 5,000, which we've now, we had this 300-point rally from early April, and we've given that all back in just over 2 months. So what it's showing you there is, the reason that our market is languishing is mostly because of the depressed state of the mining stocks right now, the resource sector, but also because if we had interest rates at 0.5% or 0, like in the US, then I promise you we'd be back to pre-GFC highs just like them.
Let's follow on with that. What do you think of the RBA's performance?
I think they've been doing quite a reasonable job, actually. They haven't been too aggressive in cutting rates because they don't want to create another bubble. They came out, after the GFC, I think they recognised that maybe you should raise interest rates while people are getting carried away borrowing money, which, surprise, surprise, to slow it down.
Yeah, I think the performance has been pretty good. I think they've handled it well, and I think they've been aggressive where they needed to be and cautious.
They've been challenged, haven't they? It's been very tough.
Yes.
Look, we must go for a very quick break. We'll be right back, and we'll be talking about Speaker's Corner and MYOB. Welcome back to the show. This is our last segment for the night, and if you have any questions on the bonds or equities, please give us a call on 1300 30 34 35, and the email is yourmoney@skynews.com.au. We're going to start with where you got it incredibly right. I asked you about when we were doing the Speaker's Corner, let's talk about what you liked, and you liked MYOB, and they'd just announced their profitability, and it had good numbers, and the market sold it very aggressively, and you said this is a mistake. Jade, have you got a chart on MYOB? Now, we've actually highlighted where Mark Bailey from Equasia, in case you want to give him some money, got it completely right. So you want to walk me through MYOB and what's happened there?
Yeah, I mean, when I came on in March, as you say, the results had come out. They were in line with expectations, but for whatever reason, the markets had sold off, behaving irrationally. I guess on the fixed income side, and our personal style of investing is we look for fundamental opportunity rather than trading the technicals and trends. Then it kind of plateaued around about the 96 level. So again, a decent capital appreciation. You've got to remember that the coupon on this as well, whilst you're holding the bonds as well, is 10% for the first year. And then
can I just butt in right there? I remember you were telling me at this point in time, if you bought that, my return, if I just held it, was 12%.
12.25%, correct? Yes.
12.25.
Yeah.
Thank you.
Yeah. Because you had the capital appreciation from the 93 back to par when it matures. At the moment, I think it's around about 11%, so it's at 98, and it still offers good value. They did make an acquisition in New Zealand of Banklink. That's 136 Kiwi dollars, and the interesting part about that acquisition was it was partly funded by 75 million bank debt.
Oh yeah.
And the private equity owners put in the additional 61 million to make that up. So that's a huge signal.
Certainly an endorsement
to investors that the private equity still believe in the management, still believe in the business, and are willing to put their capital back into the business.
Yeah.
As a result, leverage will come down, and you'll see some additional incremental EBITDA from that business once it gets integrated. And it seems to be a good business for MYOB to purchase, and synergies should flow through in future years. So at the moment, it's trading around about 98. So it's obviously not as good value as it was previously, but we're still a happy holder at those types of levels.
When I get you on next, you can tell me another one like that. We can talk to the viewers.
Well, nice. We'll see if we can find it.
Wealth-wise education's a big deal, clearly. Self-managed super funds are the fastest growing sector. How are you approaching educating those guys? And we've only got a couple of minutes left. It's been a great show.
As I said at the beginning of the show, is teaching them how to pick good quality, high quality companies, have strong, healthy companies with strong earnings growth, and also looking forward and having the right strategy in place given the macro situation as well, but also knowing the timing of when to get in, and particularly having an exit strategy, which is about 90% of investors don't implement, is having, or even if they have got it, they don't implement.
At FIIG, we think the great skill is having portfolio construction skills. It's explaining
Absolutely.
to them, how to do that. That's the key. And I definitely agree with it's a timing that's very important. But how do you go about that construction? It can't just all be equities. I mean, that's
no, I agree.
It just doesn't make sense.
I agree. We actually go through a portfolio construction in our program, one-day program, which is you've got to have a certain amount in cash, in bonds, and equities. You don't put the whole lot in equities. There's no way, but it all depends on your age, your risk tolerance. There's so many other factors.
And do you find it within Australia, because I certainly do in my line of business, that we're still very much equity centric, and people are, for whatever reason, cautious about bonds? They don't understand it, and it doesn't make up a bigger part of their portfolio.
I would definitely agree with that. Yeah, I think education is probably lacking in that market. When you talk hybrids, people saying, well, what the hell is that? Is that a bird or something?
We'll talk about that later. We'll talk about the next time you come on, because I think the bond market represents 9% of somebody's portfolio in general, which is just far too low. Look, that's all we have time for today, so thanks very much to our guests, Mark Barley from Equation and Dave Novak from Wealthwise Education, and to you, the viewers, and thank you for your phone calls, your emails. Next time, I'm Mark Todd from FIIG Securities. Have a great weekend.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.